Josh, he is an American joining a company in Dubai, but he's going to get 20% ownership. What will be the tax consequences of that 20% ownership?
Well, I mean, I think that depends on how many other American owners there are, if any, right? So, I mean, that's something that will have to be analyzed. If there's no other American owners and he just has the 20%, then, you know, he'll have to file, well, I'll let you speak to the filing requirements, but the tax consequences of the pure ownership, as long as it's not, you know, U.S. owners more than 50%, is going to be, you know, he'd have a capital gain if he ever sold it. But you might want to talk a little bit to the compliance requirements, because as you know, there's for sure going to be some of those.
Yeah, so it's just an additional form of Form 5471, where you potentially need to disclose the activity of the company, the name, address, and the financials, potentially. And as Jimmy already mentioned, if there are other U.S. persons involved, or if you have a directorship or stuff like that, it may require additional disclosure. But it's mainly a disclosure piece as opposed to a tax consequence. But having said that, some people find the cost, the compliance burden from a cost point of view to be pretty onerous. But yeah,
I would just add to that really quick that, I mean, one of the issues that I've had with clients becoming owners in foreign companies is a lot of times, especially if all the other shareholders are not U.S. people, they don't want to give you the information, right? And if you're a 20% owner, it becomes difficult to force the information and to force their hand, right? So a lot of times, you know, they'll be reluctant to tell you if anybody else is American, because they won't want to go ask the other shareholders, like, hey, do you have a second passport or this or that? They find it intrusive and they don't want to hand over the financials. And I would just add, if I'm not mistaken, you'd also, depending on the value, you need to put it on an 8938, right? Or will you get an exemption to that if you file a 5470?
Exactly. But to your point, with the reluctance to disclose, we've seen instances where, well, if you have signatory authority over the bank for the company, you need to disclose the bank balance as well, and that's something else that makes the other shareholders quite uncomfortable. But again, there's no tax consequence; it's simply a disclosure requirement. So, but Sarah, you had a question?
Yeah, I was just going to say on that, when you said onerous, how onerous is it if there's multiple American owners over 50%, potentially up to 100% of the company?
Well, you know, every how much does it cost, right? So it really depends on the complexity of it, because what we sometimes have to do is translate from whatever foreign GAAP into US GAAP, and whether they're fixed assets, we might have to tinker with the depreciation to make it US compliant. But generally speaking, on the low end, if it's a simple service company, it's a simple P&L, it's $1,500. But it can just go up depending on how complex it is.
But I would just add to that, right? Like, if you're going to have multiple U.S. owners where the U.S. ownership becomes more than 50%, then you have a whole host of other tax issues that come into play, right? Then it might be considered a controlled foreign corporation. Then you need to start looking at what types of income it's earning. You know, is it active income? Is it passive income? Is Subpart F going to apply? Is GILTI going to apply? Because when those apply, then the U.S. shareholders become liable for U.S. tax on the profits of that business, whether or not they actually received the money, right? So I think that's another thing to consider, and that will also, I mean, I would imagine, will impact the compliance side of it as well. It gets quite a bit more complex to do the GILTI and Subpart F reporting.
Exactly. Yeah. Yes, sir. In the back row.
Sorry, you said more than 50%. What about at 50%?
Mm-hmm.
At 50%, it's not a controlled foreign corporation.
Yeah. Oh. All right. Yes, sir.
It's an entrepreneur, like a freelancer or a solo company, a 100% ownership of your own company.
Sorry, can you repeat it? Sorry, just for the mic so everyone else can hear. Sorry.
Yeah. So just if it's a small company, if you're the sole owner of your own company, it's 100%. Is that a bit different, or how does it work?
Not really, right? So so let's just say, for example, you're a a freelancer, like you say, you operate through a wholly owned free zone company here in the UAE. The U.S. is going to treat that as a controlled foreign corporation, and they're going to look at what type of income it's earning, right? If it's passive income, it's going to be subject to the Subpart F regime and taxable to the U.S. shareholder, whether or not they actually receive the money from the company. Or if it's active income, it's going to be subject to GILTI and also subject to tax, whether or not they get the money. Just the rates are a little bit different, how it applies a little bit different. I mean, a lot of times in situations like that, what we recommend doing is doing a check the box election to treat it as a disregarded entity, so that basically for U.S. tax purposes, the company doesn't exist, in which case they would be treated just as a self-employed person in the U.S., right? They file a Schedule C, report all their income, they have to pay income tax and self-employment tax, and I think there's another form they gotta file too, right? If it's a foreign disregarded entity.
8858, yeah.
Yeah, exactly.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.